Now, my main focus point today concerns this topic: why real estate and gold aren't always the best long-term investments, despite what a lot of investors think. Now, this is a survey done by Gallup, and what they found was that 37% of adults think that real estate is the best investment for the long haul. That's up 1% from last year, which is at 36%. Gold is the second most popular choice. So real estate was number one. Gold is the second most popular choice here. And that was 23% of people said it's the best long-term investment. That's 5 points higher than last year. Only 16% think that stocks or mutual funds are the best long-term investment. That's down 6 percentage points from last year's report. And this was taken in early April, so maybe that skewed it here, right? Because obviously early April, there's a lot of market volatility. And so maybe timing-wise, this wasn't that great. Stocks were down, gold was up, and you can see people always chase what's hot as opposed to stepping back and looking at the long-term returns. Now, what's interesting here is that real estate isn't always top of the list here. Gold was top of the list back in 2011, and that was when it was at 34% of respondents said it was the best long-term choice. So it's only at 23% now. It shows you that I don't even think gold has really hit the hype machine yet within the average population. So that's one of the reasons why I do think gold still has more upside. There's still, everyone's not in yet, right? Usually it's when everyone's the most confident about a particular asset class, that's when kind of the top is in. But, you're not seeing that quite yet. It's up, but not to extreme levels. Now, real estate and gold certainly appreciate over time, and they're harder assets, and they certainly could over the next 20, 30 years be outperformers. I'm not even disputing that. But if you look longer term, over the last 30 years, S&P is returned about 10.3%. Gold's done about 7.4%. And real estate about 8.8. Now, that's 30 years. That's not going back further. There are certainly periods where real estate and gold outperform. But what's most important to understand here is that you don't want to tie yourself to just one. You saw that in 2008 when, I saw it here in Southern California. There were a lot of people I knew that were levered to real estate, and that was all their assets. And then you have the crash, and then a lot of them went bankrupt. And the same can be said about any asset class. Every asset class has its day in the sun. Every asset class has its rough periods. And so I think the story here is that you don't want to lean the boat all in one direction. A, because you could be wrong. But also, you need to create that diversity so that you hedge out the risk of you being wildly off base. Now, most people have exposure to real estate through their home. I don't typically think that's it's part of the picture. It's part of the financial picture. It's what we build for clients. We look at their full financial picture. That's part of their other assets, but that's not an investment. That is a utility case. And it's a utility that tends to go up in price versus your car, which tends to go down in price, right? Both are utilities to you, but one goes up in price generally to hedge against inflation. Cars typically the opposite, right? So you can invest in things like REITs. You can invest in housing related stocks. You can have rental properties. All of those are ways to gain exposure to real estate. And I think that's perfectly fine. There's nothing wrong with having that. Just because equities over long term has the best return doesn't mean that there's not a place for gold. There's not a place for REITs. There's not a place for other type of assets. But it's interesting here to see these polls that still put real estate and gold above equities, despite that longer term data that disputes that. So I want to highlight that because it's really important to have that longer term perspective and to stay diversified. I tend to like this, called the perfect portfolio. I want to say it's 25% gold, 25% equities, 25% bonds, 25% cash, and you rebalance regularly. That's to me, that's a better than like a dog to the Dow type of portfolio. So if you're looking for something like that, I like that better than leaning all on one side of the boat.